About this IMF paper on financial institutions. It's about the role of fintechs in financial inclusion. Okay, so we'll start with the abstract of the paper. And the abstract goes like this. This paper examines the role of fintech or in financial inclusion. What is fintech, right? It's about the new age technology company which are acting as banks, but these are not traditional banks. They're more digital. You can open an account just by using your mobile phone, going to the app and providing some online documents, and you can open your bank account, something that you cannot do in a traditional bank. These are the payment company, the likes of a lot of the new age technology company engaged in digital payment. In India you have Paytm, in the UK you have Revolut, in Europe you have what is that company name, German company name, N26 or something. Yeah, so these are the companies, right? And what the authors have done is that they have taken the data to analyze whether fintech is actually helping in financial inclusion, or is it doing the opposite of that. Okay, so they have taken the data on using the global Findex data, data coming from more emerging market economies, and they have found out that fintech has a higher positive correlation with digital financial inclusion. That means fintech is actually correlated with digital financial inclusion than the traditional measures of financial inclusions. That means more and more people are opening account and participating in a formal economy through banks because of the fintechs. So that's one of the finding. However, there are some not so good findings. For example, it doesn't really help in terms of bringing women, it doesn't really help women getting benefits of this. So there is no impact on gender divide. That's another outcome of the study. So the results indicate that greater use of fintech is significantly associated with a narrowing of class divide, right? So regardless of the social class, people are still using the fintech, so it's really is helping, whereas there is no impact on the gender divide, which is also an important finding. If you joined the stream, please like it. Thank you for watching. If you have questions, let me know. So the paper is structured like this. It starts with the introduction, the problem statement basically, and then you have the recent trends and the literature on this, and then you have the data that they've used, and then you have last part is the modeling and result interpretation. And finally, they have concluded with their findings. All right, so start with the introduction, and you see that this particular research is actually very difficult to do because data is not available, and without proper empirical evidence, you cannot conclude anything on such an important topic. Data is not available properly because the new age financial technology firms are not supposed to share their own internal data with outsiders. That is a data breach, right? And these companies are not directly under regulators, so you don't have the data even with the regulators. A lot of them are not under any formal regulation, so do not have that kind of data. And also because the data is only for a short period of time, isn't this fintech companies actually started sometime like 10, 15, 20 years back, right? So we don't have a longer history. And this paper analyzes as to whether fintech improves digital financial inclusion. And the second important questions what it tries to answer is, are there segments of society that are not included because they do not have the capacity and means to adopt fintech, such as women, poor, and people living in rural areas? The question is about whether people who were not able to access the formal financial system, women, poor people, people living in rural areas, are they able to access using or through these fintech companies? That's another question. Now, the traditional indicators of financial inclusion, what are these indicators? Like having bank accounts, having number of branches, right? In many countries, you don't have banks in the rural areas. So people in the rural areas have no means to save their money or to take advantage of the formal financial system, whether getting a credit, saving money to get interest on their savings, investing in different financial assets. They have no means to do that because there's simply no banks there. But and in fact many of them don't even have an account, whereas you see that with the new age technological companies, many people are able to open their accounts even without going to the banks. So whether there is a bank at a place or not, you still can open an account. So the question is about, are people from rural areas taking advantage of that? Similar situation is with the women. Many women, especially in developing countries, were simply not able to access the benefits of the formal financial system. But are they able to do that now with the fintech, with the mobile phone in hand, right? But the question is whether these people do have a mobile phone or not, whether there is access to internet or not, whether they know how to do that or not. So all these things are also playing part. Okay, and there are several indexes actually, which so the indexes are actually telling us whether there is financial inclusion or not. So there is a digital financial inclusion index. I think it was started by the Indian economist Mr. Sahai. You have Fletcher School's Digital Intelligence Index. You have World Bank Digital Adoption Index. Using this data, the authors have some sort of build a regression model to find out whether which factors are correlated first of all, and how are they distributed across different segments of the society, whether rural and non-rural, male and female, rich and poor. Okay, here is an interesting graph, which is the rise of mobile money accounts and services. This is about global Findex 2017. You see, these are all poor countries. Most of them are poor countries, and you see that in a span of 3 years. So the red line is 2014, and this is the 2017. In a span of 3 years, the number of digital accounts has increased quite significantly in these countries, right? And this is just the digital account. That means adults with a mobile money account. It's not the normal bank account. This is the global transaction through mobile money. It has increased quite sharply in the last 10 years. It was barely 5%, less than 5% in 2009. In 2019, it was over 60. Sorry, not percentage. Sorry, it's about billion. Over 60 billion US dollar transaction happened in 2019. So, this is about how people are using these accounts for. What are they using them for? is P2P transaction, cash in, cash out, merchant payment. These are some of the things they're using now. Yeah, as I said, there's lack of comprehensive data variables on digital financial inclusions. So there's simply not enough data to do this study, but I think one of the things that they have done is they have taken data from various countries and they've focused more on the segmentation rather than actual rather than just putting everybody in just one bucket and analyzing it, which is not a very good research. All right, so Mr. Shah, who was an economist with Reserve Bank of India, I guess it was. He has done this research, which is about that what are the benefits that people are getting through the fintech services, and where they are actually more engaged in, whether it's mobile payment, whether it's point and sell services, right? It's happening in India, for example. Even in the most basics of in small town and villages, people are using the mobile payment services. They're also using it for crowdfunding. They're also getting collateral loans, although that's not happening actually a lot, but some of them. Some fintech companies have started lending money to these people that they would otherwise not be getting money from a traditional bank. So that sort of research has shown that this penetration has already happened, but to what extent it is inclusive is a question mark. The new measures suggest that digital financial inclusion increased significantly in the years preceding the COVID-19 crisis. So before the COVID-19 crisis, it really entered the market. I think during the COVID-19 crisis, I think things accelerated at a very fast pace. I've seen that in India, but I'm sure this is also true in many other developing countries. However, for countries in Asia Pacific, Latin America and Caribbean, digital financial inclusion gender gaps are actually higher than the traditional financial inclusion gender gaps, demonstrating that more fintech is used, the greater the gender divide. And this is a very interesting finding from this paper, that fintechs, although are helping in many ways in increasing the financial inclusion or making it better, but when it comes to gender divide, it's the opposite of it. That means the more fintech is used, greater the gender divide. And it's very interesting as to why. Is it because women do not have the mobile phone, they don't have access to internet? Are they scared of using these services because of lack of trust, which could be a reason? Or there could be other reasons. For example, women do not want to share their data. I think this also is this may be one of the reasons why they don't want to use these services. They also found out that the gender gap was smaller among products that complement traditional banking services related to those that are substitutes. Women are more likely to adopt fintech products that complement financial services, which is that because even the traditional banking service companies, the traditional banks, they're also providing fintech services, fintech products. So women tend to believe in these sort of organizations where fintech is more of an additional service, fintech service. Mobile payment is an additional service, but they do have a bank branch in that region, compared to a pure play fintech company which doesn't have branches all over the country but just a mobile payment. So there the trust is much less, and hence women do not tend to use these services as much as men do. Similarly, it was also seen in the Asian payment system, both traditional and digital. The gender gap persists even in digital models like mobile money, which is what the other study also said, right? And then there are some bad things about what's going on with fintech and how it's not helping in financial inclusion. The business models of fintech startups are geared towards solving real life problems such as payment apps that make it almost free and painless for migrant workers to send money home to the remote villages, right? Which is wonderful thing actually. People working in other big cities, they can send money home just by using the mobile phone. That used to be one hell of a task for them, right? Going to the bank, sending money, and then waiting for a couple of more days to for their family to get the money back home in the villages. But that's now happening instantly, so that's a wonderful thing. However, as digital financial services become more ubiquitous and gain greater traction, researchers and regulators are becoming more aware of the dark side of fintech. So there are some issues with the fintech which the authors have discussed here. For example, the benefits are not going to the minority section of the society: women, aged people, poor, and minority groups. Many reasons: lack of access to digital infrastructure such as mobile phones, computers, internet, financial and digital literacy. A lot of people simply do not know. Women do not know even more, because obviously the literacy rate itself is relatively lower compared to men, and women simply do not want to use more sophisticated techniques to do things. It could be because of lack of financial and digital illiteracy. Potential biases in algorithm, it could happen, right? The algorithms used for assessing credit worthiness of customers, that may be may be biased towards certain section of the society. And the research has shown that women in general have lower rates of bank accounts ownership than men. This has been an outcome of the research by many people. So this could also be reason why, but it shows that women do not simply want to participate, because a lot of time women do not have an income. Actually, a lot of poor countries, women do not work, they do not participate in the formal economy, they do not do anything actually. So it will never be the case then. A recent paper by the BIS found that 29% of men use fintech products and services compared to 21% of women. The fintech gender gap, 8%, was larger in the gap, right? So men use the fintech products way more, about 8 percentage point more than the women, which is quite significant gap, right? And they have also delved into the reasons why women do not use, or maybe use less compared to men. Women worry more about the privacy and personal data protection than men, which is quite obvious, right? Especially in poor countries. Sure. According to Alliance for Affordable Internet, only 48% of women has access to the internet compared to 55% of men globally. So there was a gap of 7 percentage point, which is quite again significant. Aging and financial inclusion, as in how elderly people are using them. I think it is quite obvious that they will not like it, right? Who would like to change things at that age, right? Nobody. So it's quite obvious that older people are not getting the benefit of this system. And then you have biases in algorithm scoring. This is quite a topic actually. A lot of fintechs are using the AI algorithm, machine learning algorithms, where the only emphasis is given to prediction accuracy, even if it at the cost of being biased towards certain section of the society, and that's still fine for them. It's not the case in traditional banking, because in many big banks, they do not use the big banks do not use very sophisticated algorithms, and they're not supposed to use because of regulations. So it is easy to understand whether an algorithm is biased towards certain section of the society or not. Whereas if you use sophisticated AI algorithms, things are very difficult to analyze. Then you have some visual plots actually. One is on the number of accounts for male versus female. You see a huge difference, right? The blue part is the male, the red is the female. See a very huge gap. Then use internet to pay bills, again very different. Male dominated by in all regions, by the way. In the y-axis you have different regions. And then you have digital payment, again quite different. Rich and poor, more rich people are using fintechs compared to poor people, so it's not helping in many ways, right? Especially on gender and rich and poor, it is simply not helping. Okay, now they have used some data to build a regression model to find out the factors impacting the financial inclusion. They've taken this World Bank Digital Adoption Index and such things. This is the correlation matrix. You see the number of accounts with branches and Digital Financial Inclusion Index and how they are correlated. I think they have already discussed this. This is the empirical model. So you have the financial inclusion is a factor of the fintech variable, as in how fintech is affecting, and x variables are the control variables, which is per capita income, education level, population, etc. Right, because that could also have an impact. So you ensure that you keep them fixed and then analyze. So these are control variables. First, what they have done is we ran panel regression with fixed effect to examine the effect of fintechs or financial inclusion using various traditional and digital financial inclusion measures and different proxies for fintech. As shown in table 3, the correlation of fintech proxies by Leapfrog and capital raised have positive signs and statistically significant in most regression with digital financial inclusion and digital intelligence. The results suggest that the two fintech proxies have a positive effect on digital financial inclusion that is consistent with the emerging literature. I think important to look at the results of this regression. So fintech is positively correlated with the especially I should not look at the first 4 and see about the cell phone and the more cell phone people use is more likely that people will use fintechs. Similarly about internet. Education level, it goes without saying, right? More educated people are more likely they are going to use credit to GDP. The higher it is, lower adoption it is. Credit to GDP means more credit and less GDP. Sign of a poor country, right? You have R square of 78%. And then they have also analyzed about whether there is a gender divide in this. You see also many significant variables here. Well, this is a correlation matrix, I think, right? Yeah, there's some significant correlation also, quite significant correlation. Rural divide. Yeah, what about gender divide? There one. Yeah, this is the gender divide, which is also quite highly correlated. 8%. So what are the policy? Okay, we'll go to the conclusion and we'll stop here. A higher level of financial inclusion will be achieved when policies succeed in extending financial services to a broader segment, which is the important word to note, right? It should not only be useful to the rich and the affluent and the urban population, but to the entire population. In an efficient and sustainable manner, the paper draws 3 conclusions. First, fintech has a positive correlation with financial inclusion. The correlation is greater when digital financial inclusion measures are used as compared to traditional measures. Second, fintech has played positive role in bridging the digital access gap between rural and rich poor populations. Third, fintech has no correlation with the gender digital gap. So on the gender gap, it's still not doing helping at all. Our findings highlight the importance, or maybe it is helping. There is no enough good enough data. That could be. Our findings highlights the importance of leaving no one behind when promoting fintech services. While fintech has divided some promises in reducing the rural rich poor gap, more work needs to be done to close the gender gap in access to financial services. Fintech development may need to be complemented by targeted policy initiatives aimed at improving women's access to internet, addressing differences in attitudes, challenges across demographic groups. These challenges include discrimination or social norms, laws that disadvantage women in many countries have. Good paper, right? It's not very sophisticated one, easy to understand, but also very important topic which nobody is doing research on, right? Nobody knows how fintechs are useful in financial inclusion or not. This research is this topic is not getting enough attention from academia. So good that IMF